Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Brian Stutland, Managing Partner at Equity Armor Investments, and George Tkaczuk, Portfolio Manager at RCM Wealth Advisors. They join me to discuss if a rising unemployment rate is actually good news for the stock market. Gentlemen, it's great to have you both with us. Welcome to Trade Talks. And Brian, let's start off with that question. Is it potentially good news because the market seems to be digesting, the data that we saw this week as if it is good news?
Yeah, bad news is good news. I mean, when we heard Powell speak earlier in the week, basically he's saying he was kind of along the lines of data dependent. We're probably going to get a cut. We're probably most definitely not raising rates. If anything, we have to hold steady. So now that we've gotten an unemployment report since he's spoken, that was not so great for the economy basis, but that is one where now traders are thinking, hey, maybe we do actually get a cut in the back half of the year. And if we do, if you look historically, really, when you're looking at like 10-year rates or 2-year rates, once they've risen, that's been bad for technology stocks. But once they sort of paused and held still after that rise in rates, and in this case, actually have come off those levels, the 2-year note dropping from over 5%, now back down around 480, that's been very bullish for stocks. And I think that's why we're getting this recent rally today and over the last couple of days.
Mm-hmm. And George, let me ask you the question. Would you rather have a rate cut or a stronger, healthier economy?
That's a tough question. We'd like both, obviously. And so the problem is with today's job numbers is in the back of your mind, a few months ago, everyone was talking about a recession. This year it hasn't happened. Everyone forgot about it. So the question is, will these bad job numbers or bad economic numbers start pushing us into a recession? That's a question that traders have to have in the back of your mind. But in the meantime, this is good for the market. The low numbers today, employment numbers, and so the yields dropped and equities are reacting in a very positive way. We're seeing the Nasdaq getting above the 50-day moving average today, so that's a good sign so far. We'll see how we're close because we've kind of been baited into these mornings where we get these gap up, nice morning trading ranges, and then by the end of the day, everything fades. So we'll have to see how this goes.
Right. And Brian, when you think about it from a technical perspective, and then you also have to keep in mind the valuations where a number of these indexes and stocks are. What are your thoughts around, like a major index such as the Nasdaq in terms of looking for buying opportunities?
Yeah, well, now that we're through sort of the earnings seasons of the Mag 7, the big names in the Nasdaq, I do have to turn to the technicals, Jill, like you said. And really the Nasdaq 18,000 has really been a key number here. It's almost like sell when the Nasdaq is above 18,000, buy it when it dips below it. So this is really a key level I'm watching. Really, the market started breaking down a few weeks ago, 18,200 level. So I think if the Nasdaq trades back above that level, all systems are go for upside participation in this market. And like George mentioned, yields backing off here, probably kind of bullish. The Nasdaq trading above the 50-day moving average right now. So all signs kind of lead to a bullish trend where this recent, pullback was just that, just a pullback, an opportunity sort of to buy. So I think any dip or any price trade below 18,000, I'd be a buyer in the Nasdaq.
Right. And George, let's talk about repricing risk here. Are higher rates here to stay? If according to Powell's commentary, it doesn't sound as if, we can expect lower rates in the very near future.
That's very true. However, one of the positive things, and I think this actually happened in early November when this whole recent rally started, he pretty much at that meeting hinted that no more rate hikes. And that was market took that as very positive, although he didn't say when there's going to be cuts, but he said no more rate hikes. And that theme is continuing until a few weeks ago when the market started to roll over. Right in April, you had some of the Fed governors going out doing speaking events. And then they were talking about how maybe we are going to do a rate hike. Powell stayed away from that at his last press conference. So that's a good thing. Will the rates stay up here? Well, it is an election year, and I know it's not supposed to be political. And the Fed, they have to service their own debt at these higher rates. So I think if they get an excuse like today, they may cut. I mean, not a lot, but enough to make the equities rally.
Right. And Brian, is 25 basis points really enough at this point for a rally?
Well, yeah, that's an interesting question, Jill, because before, we had people thinking, 6 rate cuts, then it reduced to 3, now it's maybe 2. And I think the market's going to like any sort of rate cut is going to be bullish for equities at this point. So I know market expectations are maybe for a couple, rate drops here of, let's call it, 25 to 50 basis points. But if we just get 25, I think the market's going to like that. I'm not sure we actually do get that. The data right now is trending the wrong way. If you look at the previous CPI numbers the last few months, it's now on an uptrend where it looked like it was declining, looked like we were going to trend down towards that 2% target level that the Fed has talked about. And that seems to be reversing. And so that's going to be one thing. I know the unemployment report was sort of, indicative that we could get a rate cut. But when you look at CPI numbers, that hasn't turned lower yet. I'd like to see that happen. But the market's going to love a single rate reduction here at this point, because that's really going to mean valuations in this market are going to go higher, given the strength in the earnings picture that we just saw come out. I think a lot of bullishness around that. So any sort of rate reduction means valuations have to go up.
Right. And Brian, outside of equities, what about gold? Has that trade peaked at this point?
Well, that's a good question, Jill, because obviously we had a huge run in gold and we sort of saw it break out. And I kind of want to bring up a chart just so, viewers can kind of take a look at what I'm looking at here. But when you look at the breakout in gold, it's now pulled back a little bit. Once we saw the 2-year note get above 5%, people sort of rotated out of gold. They looked to sort of sell their bonds. They were kind of selling everything really at that moment. I think, though, if the economy looks to weaken, historically, gold has moved to the upside, because what has to happen? The Fed needs to pump more liquidity into the system. A rate cut would mean that. And I think there's some opportunity. Any sort of pullback in gold to the 2100 mark, whether you use an option to sell a put to sort of, echo that sentiment, I'd be looking at those levels to get in and creating some sort of option trade where I can get some optionality to the upside here. Because I think if we do get a rate cut with inflation staying to where it's at, I think gold's got to go higher. It's going to take a little breather right here because of the rate move up that we saw. But as sort of rates come down and back off a little bit, I think gold's a good area to sort of diversify your U.S. dollar holdings, so to speak.
Mm-hmm. Let's switch gears to earnings season for a moment here. And George, we're not quite out of the earnings season woods just yet, but what sectors have you identified that have been emerging front runners so far?
Okay, well, this earnings season has been mixed so far, but some of the front running sectors that industry groups have done very well, for instance, have been retail, restaurants. If you take a look at a lot of those stocks in that group, they're performing quite well, like Chipotle, CMG, Shake Shack, SHAK. Cabo Restaurants still in that report. That's a new company at IPO, CAVA. Wingstop reported, I believe yesterday, today, they're holding up. They're doing well. First Watch Restaurant Group, FWRG, they're doing very well. They reported. So that's kind of unusual group that's doing well now, considering we're really the driving theme behind this market is really the AI market. So some groups have reported, some stocks in that group have reported well, but there's others groups that are spin-offs off of that, meaning kind of you wouldn't think of them as really technology stocks, but those are the ones that are providing electrical power, or the construction companies who have to build out that grid, because all these AI servers and everything are going to suck up a lot of electrical power. So those groups have been reporting and doing very well. A lot of stocks in those groups. I don't know if you want to go through any of those, but we can look at stocks like VRT or NVT, POWL, some of the construction stocks like PWR, GVA. There's been good reports out of those things, and that's kind of driving part of this environment, and it's part of that kind of big picture, big liquidity theme of the AI theme in this market.
Yeah, George, and I think it's an interesting point that you bring up. I mean, you could develop all the technologies you want, whether it's EV, data warehouses, any of the AI derivatives, but unless you have the power and the infrastructure and the public utilities to support that, and the minerals and the metals that it takes to build all these things, it really seems to be where the trade in the future of it is, because you can't, advance these technologies unless you have the power to do so. But Brian, I thought it was interesting that the sector that really showed some strength here was the consumer sector as it relates to restaurants. What do you think is driving some of those underlying factors as it relates to that sector and other sectors that you identified?
Well, it's interesting because, speaking of Shake Shack, I went the other day, I ordered a cheeseburger, a fry, and a shake, and it was $20. So, I mean, these guys are getting pricing power where they can raise prices, increase profit margin, and then expand out, something like a Shake Shack where they've done very well. It's because they've been able to sort of grow out their business. They're still sort of on the small end relative to a McDonald's, which is more, across the globe. So people are looking for those growth names to purchase and see the expansion there. As sort of we enter this sort of dovish scenario with the Fed that we talked about, if we enter this inflationary environment, who has the pricing power to expand? And those sort of names are the ones that have been the winners over the last few months. And so those are ones that have done really well.
Yeah, well, Brian, it's interesting because is it really inflation is higher, or these companies have the ability, to your point, have the pricing power to improve their margins? It's a very confusing signal to the consumer, right? All they hear is about inflation and the economy, and it's really companies that are almost taking advantage of the fact that they can use that as a way to improve their margins. Does that calculus make any sense there?
Yeah, it does. And I think it comes down to just uniqueness of the brand name that's taking place. If you look at sort of like a consumer staple stocks, they've kind of struggled relative to the rest of the market. And then you turn to consumer discretionary, it's really the names that have some unique brand name behind them where you're seeing growth and expansion in their product is where people have been flocking to for investments, and not sort of the old, consumer discretionary. Let's say Nike of the world has maybe underperformed a little bit relative to some of these other brand names that are creating some unique niche in the marketplace.
Mm-hmm. And Brian, looking to the volatility markets here, what is the VIX saying? What are these levels saying? How can it be used to assess potential market movements here?
Yeah, well, I mean, we've seen volatility come off here, and it's kind of been an interesting trade. Obviously, there was some skittishness. I think one thing that's kind of interesting, and this is sort of a unique little index that we use, and it's one where we look at calls and puts in the Nasdaq 100 and 1 month options. So when we see puts rise, people buying insurance on the downside, and the demand for that is greater than, let's say, a call option, we see what's called the skew index rise. But what we've seen over the last few cycles here is actually volatility has gotten high. There's been this built up pent up nervousness in the market where option premiums rise, yet all of a sudden the skew index shifts and there's this demand for calls relative to puts. People start dumping their puts, they dump their insurance, and they're looking to the upside on the call side. And that starts to fall and come off a lot faster than the rest of the market anticipates. While the market's still nervous, that's coming off. And so that's led to some pretty big bull runs of 3 to 5% to follow after that, as I kind of highlight on this chart. So we sort of got that again in this recent last couple of weeks. And so that's where I'm thinking, hey, NASDAQ 18,000, we get above 18,200. All these call buyers that are sort of predicting the upside, these are institutional traders. They're very smart traders. We'll sort of get that run to the upside.
Mm-hmm. George, do you think options traders have this right or wrong?
Well, I like to use that put to call ratio as a contrarian type indicator. If you look at when that last chart that Brian showed, the spike in that put to call, that's actually was, I believe, April 17th. And April 19th, we got a bottom, short-term bottom, at least on NASDAQ. And this was the first kind of really true correction we've had since that November rally started. And on the dime, the market turned, and it wasn't that extreme of a movement. So I think, for me at least, that's how I use that as a good contrarian indicator.
Mm-hmm.